Hello friends, today we are going to see capital gain head in continuation to the previous part. Capital gain is an fourth head of income. Today we are going to see these sections and this important part of the capital gain head. First thing that we are going to see is transaction not regarded as transfer under section 47. Then it comes transactions not regarded as transfer under section 47. Then format for computing short-term capital gain and long-term capital gain. We have seen definition already, which was given under section 2 subsection 47. Now we are going to see this definition of transfer in detail, wherein we will see which are the transactions which are not regarded as transfer and which transactions are not regarded as transfer under section 47. So few items which are not regarded as transfer starts from section 46 subsection 1, which says distribution of capital asset in the event of liquidation. So when any liquidation of the business is occurring, at that particular time when any capital asset is being distributed, at that particular time such a distribution would not amount to any activity which is termed as a transfer in head capital gain. Next is section 47 clause 1. So distribution of capital asset on total or partial partition of HUF. So when HUF is being dissolved or being partitioned, at that particular time if the assets are distributed among the co-partners, then such distribution will also be not termed as an transfer as per definition of transfer under section 2 subsection 47. So we can call that these are the exclusions from the definition of transfer given in section 247. Next item is transfer of capital asset under a gift or a will or an irrevocable trust. When I am giving any such capital asset which is a gift or will or an irrevocable trust, then it will never be termed as an transfer. I cannot call it as an transfer when such assets are transferred, because when I give gift I don't take it back. When it is as per the will, it can never be taken back. And again same thing is with the irrevocable trust. Irrevocable itself means that I cannot revoke it back. So few items are again section 47(4), that is clause 4 says transfer of capital assets by 100% holding company to its Indian subsidiary company. So when I am holding company and I am giving any such asset to my 100% subsidiary company, that I am holding 100% shares into such company, then I become 100% holding company. Then in this case I can give my capital asset and it will not be regarded as transfer, but it should be an Indian subsidiary company. Holding company can be Indian, foreign, anything, but the subsidiary company should be Indian. Next clause says, clause 5 says capital asset by 100% subsidiary to Indian holding company. Now the receiver should be Indian in this both clauses, whether the receiver is subsidiary company or the holding company. Whatever is received, or the person who is receiver, I mean to say the business who is receiver, should be an Indian company. Then such transactions will not be regarded as transfer. Then when transfer is in a scheme of amalgamation of a capital asset by amalgamating company to amalgamated company, means when I am transferring a capital asset, amalgamating means old company and amalgamated means new company. So when old companies are transferring such assets to the new company, that is initially there were two companies, A Limited, B Limited, they are now amalgamating, so they are called as an amalgamating companies. A Limited and B Limited both are amalgamating companies, but when they form a new company called as an AB Limited, then such AB Limited is called as an amalgamated company. Then in the scheme of amalgamation, whatever assets are transferred will be called as an not transfer in capital gain head. Next is transfer of capital asset by a banking company to the banking institution in the scheme of amalgamation. Means like as similar to the other part like of amalgamation, when banking company is giving it to the banking institution, and again the arrangement is of amalgamation. So when there is a scheme of amalgamation, no asset given are or no asset transferred are regarded as transfer in capital gain. Transfer in the scheme of demerger. Now this demerger is exactly the opposite of amalgamation. So demerger means initially the company was AB Limited and now two separate companies are coming into existence. The resulting companies are two, A Limited and B Limited. Then in such event of demerger, we can say that any such transfer of capital assets by the demerged company, that is the old company, to the resulting company, that the new two companies, will not be regarded as an transfer. Next is clause 6CA. It says transfer in the scheme of demerger of the capital assets by the demerged company to the resulting company. So when capital assets are being transferred in such demerger. 47(6)(d) says transfer or issue of shares by the resulting company in the scheme of demerger to the shareholder of the demerged company. So when there is demerger and few assets are being transferred to the shareholder, then in that case also no transfer will be as per the transfer of this capital gain head, and it will not be made taxable. Next amounts to 7A clause says transfer of capital asset being foreign currency convertible bonds, that is CCB, or GDR, that is global depository receipts, which are referred into section 115 AC1, then such transfer is also not to be regarded as an transfer as per Income Tax Act. Next is transfer by way of conversion of bonds or debentures, debenture stock or deposit certificates in any form of company into its shares or debentures of that company. So when I am going to transfer it by way of conversion, bonds or debentures into debenture stock, deposit certificates, etc., into shares or debentures of that company. Like we many of the times receive convertible debentures, convertible bonds, then on such conversion they will again not be regarded as an transfer in capital gain head. Next is transfer by way of conversion of bonds referred in section 115 into shares or debentures of a company. So when I am transferring them into shares or debentures, bonds are being transferred. Again they are not a transactions which are transferred. Transfer by way of conversion of preference shares into equity shares. So conversion from preference to equity is again not regarded as transfer. Next is transfer in the scheme for lending of any security under an agreement or agreement which assessee has entered into with borrower of securities and which is subject to the guidelines issued by SEBI or RBI. So when such scheme of lending of securities is done and where assessee has entered into with the borrower point of view, from borrower's role, then it will not be regarded as transfer if it is as per the guidelines provided by SEBI or RBI, as the case may be. Further, we have transfer of capital asset in transaction of a reverse mortgage under a scheme made by and notified by the central government. So if there is a situation of reverse mortgage and the capital assets are being transferred, then it is again not regarded as transfer in the capital gain head. Further, transfer of capital assets, which can be a special purpose vehicle, and it is now transferred to a business trust in exchange of units allotted by such trust to the transferor, then it will not be regarded as transfer. So these were few important transactions which are normally very much occurring into our daily business activities. There are few more, but these are more important transactions, like few selected transactions we have considered here. Let's move on to next. Now, as we have already learned what are types of capital assets. So it was short term and long term. As we have already seen, it has a basic criteria of 36 months to be held. Sometimes we have an asset to which such clause of 36 months cannot be made applicable, and in that case we make the additional provision applicable here, which is as 12 months and 24 months. So whatever the case may be, whatever the criteria applied may be on basis of type of asset or the nature of the asset, may it be 12 months, may it be 24 months, may it be 36 months, we need to compute two types of capital gains, or the capital gain has to be computed identically. When it is short term, it has to be computed like this. When it is a long term, there is some addition into it. Let's see it afterwards. Right now, let us focus on short term capital gain computation. So I start up with this first item called as an full value of consideration. What is full value of consideration? It simply means whatever I have received on such transfer. Say I am selling off my capital asset for rupees 5 crores, then whatever expenses are there, whatever is there, irrespective of that, like for what item I have purchased it and what, it's like immaterial here while considering the full value of consideration. What is actual full value of consideration? It is something that I have actually received. So it's something what I am receiving on transfer of capital asset. From this, now I am going to deduct three items called as an cost of acquisition, cost of improvement, cost on transfer, like I incur some expenses on transfer, so cost of transfer is also deducted, and whatever resultant value I receive is termed as an short-term capital gain. So let's see each concept. What is full value of consideration? Full value of consideration is what we have received on transfer, which we discussed. Now let us focus on cost of acquisition. What is cost of acquisition? What was the value on which I have purchased my capital asset is termed as a cost of acquisition. Next, cost of improvement. What is cost of improvement? It may happen that after purchasing I need to improve my capital asset, and when I am improving my capital asset, it may be leading to some expenditure to me. So whatever we call as an capital expenditure for improvement of the capital asset is considered under this head, that is cost of improvement. And while transferring, I may incur some expense like brokerage, commission or registration charges, etc. So these expenses are also deducted from the full value of consideration. So whatever I get after deducting these three items is termed as a short-term capital gain. Next, as similar to short-term capital gain, I am going to have long-term capital gain as well. Here, the first item remains the same, full value of consideration. Then comes something cost of acquisition, then something cost of improvement, then comes as earlier expenses on transfer, and last whatever resultant value I get is termed as a long-term capital gain. Now what that something was, let's see in detail. What is this indexation? So when I am holding any capital gain, I am holding capital asset, and resultant benefit that I will receive will be termed as a long-term capital gain. Then there might be inflation changes. So from this point of view, we need to understand that cost of acquisition needs an indexation effect. Cost of improvement needs indexation effect. So for example, you have an asset which was purchased by your ancestors, say 50 years back, and that particular asset was purchased just for rupees 10,000 or so. And today you are selling off that asset for, let's say, 7 crore rupees. Then is it going to happen that you will just deduct cost of acquisition of rupees 10,000? Absolutely not. Which simply means you are going to compute the cost of acquisition on indexation basis. Similar thing will happen in case of cost of improvement. Again, you are going to index your cost of improvement, and on indexation of both this, we can say that now my cost of asset and selling price, that is full value of consideration of my asset, are comparable. First of all, I make them comparable, then I deduct these expenses from this, and this is as regular as we saw in the short-term capital gain as well. So this is a regular my capital expense, capital transfer expense. So when I transfer the asset, I need to incur some expense which are deducted here. So whatever resultant figure I am going to get will be long-term capital gain. So I repeat, from my sale value of a capital asset, which is termed as an full value of consideration, what happens is I deduct my comparable, that is indexed cost of acquisition and indexed cost of improvement. So when I deduct these values, then I can say that I am deducting the comparable cost of my assets and cost of improvement of my asset from the sale value of the asset, and then I am deducting expenses on transfer of such asset, and whatever resultant value I get amounts to long-term capital gain. So one was short-term capital gain, and now we have seen long-term capital gain. Computation remains the same, only on the basis of classification or the types of capital asset we need to compute whether it is, if it is a short-term capital asset, we'll compute short-term capital gain. If it is a long-term capital asset, we'll compute long-term capital gain. So capital gains can be anything, like we may actually receive it, we may not actually receive it. It can be our future receipt also, but we are transferring it today. But as per the definition, it is very much important for us to remember that we make such capital gain taxable at the same time when we are transferring it, because whenever we have actually transferred in that particular year itself, our assets get taxable, I mean to say our capital gain gets taxable, and we have to pay tax on it in that particular previous year only, even if you are going to get it some other way or some other year. It is being made taxable in the year of transfer itself. So may it be a long-term capital asset or a short-term capital asset, we will compute it with the stated formulas and with the help of all the basic concepts such as what is capital asset, what are the types of capital asset, short-term, long-term, and we'll also consider all the transactions which are not regarded as transfer given in section 46 and section 47, and we'll compare them with section 2 subsection 47, which gives us the definition of transfer, and then we'll decide whether our asset is going to get taxable or not. So just to revise, we'll revise the formulas and we'll compute the capital gain. So what we'll start off with, we will go on to full value of consideration whatever we have received, then we'll deduct cost of acquisition from it, then we'll deduct cost of improvement from it, and whatever resultant value we get will be our capital gain value. Now if the asset is short term, then we'll just deduct the cost of acquisition and cost of improvement, but at the same time if the value of asset is not a short term in nature, or the asset was not purchased in the specified time period, it is beyond that, that is beyond 36 months, 12 months or 24 months, whatever the case may be, then in that case we cannot deduct just the cost of acquisition. In that case we are going to deduct indexed cost of acquisition and indexed cost of improvement, and with the help of these deductions we get a value of consideration which can be made taxable. But on that value, whatever we have received after deduction of cost of acquisition and improvement, we have to deduct one more item which is called as an expense on transfer. So such expense of transfer need to be deducted, and final value what we receive is termed as an capital gain value. May it be long term, may it be short term. So this is what we have seen for the day. All of you, if any doubts, you can reach me at any time. Thank you.